Hi, everyone. This is Thomas Newth with DeNexus, the head of marketing, the vice president of marketing here. Thank you for joining the webinar, Bridging the $1 Trillion Risk Gap. Obviously, I won't be hosting. I'm joined here by our founder and CEO, Jose Seara. And before we kick it off on covering, this $1 trillion cyber risk crisis that both industrial asset owners and the underwriters of risk, being cyber risk, face, I want to go over the poll questions. For those that have not seen or answered the poll questions, I just want to let you know that in your feed, in your interface, you guys can see that you can answer these questions anonymously, and then we can go over them in the end or follow up with an email and give you the results. There's 4 questions. Question 1 is, what best describes your role or company? Are you an industrial asset owner with security responsibilities? Are you operating at the SOC all the way up to the CISO? B, are you an industrial asset owner, but on the financial risk side, you're managing, your risk exposure for the company. You could be a CFO or in that office. C, are you an insurance or reinsurer, issuing insurance products to these industrial asset owners and industrial organizations? Or last but not least, are you an insurance-linked securities or ILS investor? If you answered A or B, if you're affiliated with any industrial enterprise. Question 2, we want to know if you've procured an insurance program or policy in the past to handle the growing and mounting cyber risk challenge for your operation. Also, following up on that 3, if you are an industrial asset owner, have you seen or do you expect in the near future your policy for cyber risk to increase? And if so, is it greater than 100% or is it lower? We're seeing a lot of policies increase from the 2020 to 2021. And then, of course, this next year in 2022, these cyber insurance policies rise considerably. And then the last question is, if you're an insurer or reinsurer, are you offering what we call affirmative cyber insurance now or plan to in the near future? Of course, for the industrial side, you guys might not know what that is. I come from cybersecurity myself. I did not before I joined DeNexus. I just knew that cyber risk was a problem. So Jose will explain that as well as so much more of why DeNexus is here and the problems that we're solving. So with that, I'm going to hand the mic over to Jose. And Jose, you can get started.
Perfect. Thank you, Thomas. And good morning, good afternoon, good evening, everybody. Welcome everybody attending this webinar from different places. This is certainly a global topic. My name is Jose Seara. I'm the CEO and founder of DeNexus. And today we are going to talk about cyber risk for large industrial enterprises and how, despite the fact of aligned interests and high demand, the hard truth is that the exposure to cyber risk is growing way faster than the rate of cybersecurity innovation. And the ability of the insurance companies to underwrite this cyber risk is lagging even further behind. As a result of that, the industrial sector of the global economy is facing a risk and capital crisis that is consequent upon potential catastrophic cyber risk events. This capital crisis could be a capital gap worth hundreds of billions of dollars. In fact, in 2020, less than 1% of the $1 trillion of potential loss due to cyber events was transferred to insurers. And that compared to 25% of natural catastrophe risk transferred from the owners of the risk to the insurance enterprises indicates how immature this space is. And we do not expect that ratio, that coverage gap ratio, to grow any further significantly in 2021. Meanwhile, cyber attacks keep accelerating in all verticals, as all of us know. In the US utilities were attacked 300 times per week on average in 2021, representing an increase of 50% compared to the first half of the year. This is data coming from Checkpoint. And the average energy cyber breach cost near $6.5 million, according to IBM. And in the meantime, 81% of the executives working for these companies believe that they are not well protected against cybercrime from the insurance perspective. So this is a clear representation of that gap. So all of these leading to this cyber risk crisis. Let's begin understanding what is cyber risk and what is the nature of that risk. So what is cyber risk? For us at DeNexus, cyber risk is just another enterprise level risk. but one that is quite special, to be honest. One that is poorly understood, and mainly because there is insufficient empirical data, insufficient historical empirical data. One that is highly dynamic with really fluid risk drivers, and one that is impacted by both internal and external factors, including human behavior, whether that human behavior is intentional or not. All of these results on events that could result on systemic risk, which may or may not be insurable, or even systematic risk under certain circumstances, such as these crazy random ransomware attacks. And systematic risk is arguably a non-insurable risk. Two critical stakeholders impacted, the two sides of the risk, the asset owners, industrial enterprises in one side, and the insurers and reinsurers on the other side. A few more key data points here to help visualize the impact of the situation. According to Gartner, 75% of the CEOs will be personally liable by 2024 due to cyber events. And this is the same C-suite population that a couple of slides ago thought that was underprotected on 81% of the cases. 500% growth in ransomware attacks in industrial systems just in 2020, staggering number, and $20 billion of estimated costs due to ransomware in 2020. Meanwhile, on the insurance side of the equation, 58% of the US enterprises, of the US organizations, do not have cyber insurance as we speak. While the industry is running at a relatively high average loss ratio, close to 70% in 2020, and certainly a number that unfortunately is going to grow significantly in 2021 because the insurance industry has realized significant losses on their cyber exposure in 2021. And in parallel, premiums, the price of getting protection keeps growing. 96% of premium increase year-over-year comparison in Q3 last year, or a 40% increase compared just to the previous quarter. So less protection, high average loss ratio, and increase in premiums. And in the meantime, important critical questions remained unanswered, and they remain unanswered for both sides of the risk. On the industrial enterprise side, what is our risk reduction return on investment on cybersecurity investments? And cybersecurity investments are a broad concept. We invest in tools, in platforms, software, talent, technology, training. Are we spending our security team's time and resources in an optimal manner? That security team's time is a precious, really a scarce resource. Are we allocating that time properly? Are we overspending on defenses that where the risk reduction just doesn't justify the price or the investment? And the situation doesn't get too much better on the insurance side of the equation. Are we doing a proper risk selection? Are we writing the risk that we should? Or we should be writing a different type of risk, a risk that has been previously managed and properly mitigated? Are we allocating the right amount of capital? And are we collecting the right premiums to cover future claims and losses that for sure will come? Are our accumulation assessments and catastrophic scenario analysis correct? We don't really have answers to those questions. And all of that is leading to the industrial sector of the global economy facing a real risk and a real capital crisis that could represent a risk capital gap of $1 trillion. Now, the million-dollar question is, what do we do to close the gap? How we can close the gap? Let's begin talking about cyber resiliency over cybersecurity to begin with. Let me read you this definition of resilient systems. A resilient system protects its critical capabilities from harm by using protective resilience techniques to passively resist adverse events and conditions, or actively detect these adversities, respond to them, and recover from the harm that they cause, because they will be a event that results on a loss, and there will be an event that we need to recover from. So how do we build that resiliency? We build resiliency through proper risk assessment, through proper risk management, mitigation, and eventually transfer. Investments in cybersecurity follow the law of diminishing returns. What that means is that at some point, the marginal effectiveness of every single dollar spent will be less than the previous dollar spent. That leads to investing in mitigation only on the left side of the curve, where the investment in mitigation is efficient, and acceptance of some tail risk, or eventually transfer of some volume of risk, where there is a much bigger reduction of risk benefit achieved through insurance. But we know at this point that the insurance industry as a whole is not able to write a meaningful amount of that risk. So we need to manage and mitigate the risk. How can we measure the effectiveness of that? Years ago, there was not even qualitative measurement. Then it came to the industrial cybersecurity space, but that is truly insufficient for proper understanding of the risk, proper management, and transfer of that risk, as we will explain later in the webinar. Risk scores are, of course, much better than nothing, but they are clearly inefficient, biased and not normalized, 250 through 900, or 0 to 100, or 1 to 10, A to F, 0 to 950. What that really means. So at DeNexus, what do? We have built the first evidence-based risk quantification platform for industrial environments and insurers of this large cyber risk. Our platform, the risk, is data-driven. It self-adapts to each client automatically, and it produces continuous risk quantification of this dynamic or even volatile cyber risk. Our mission is to build the global standard of industrial cyber risk quantification for agencies, for shareholders, for investors, boards, and for the risk transfer market. And by doing so, enabling the underwriting of this large industrial cyber risk at the scale. So we go from that less than 1% ratio to eventually 1 point something, 2 point something, etc., until sometime in the future we achieve a proper coverage of that risk. Now, with DeNexus, risk owners and underwriters can answer the questions. As an asset owner, I can value my cyber risk. I can defend my operations according to my value at risk. I can mitigate my exposures according to the return on my investment. And I can optimize and prioritize security investments, and I can optimize the use of the time of my security team. As an underwriter, now I can make a superior selection of the risk that I underwrite versus the one that I don't want to underwrite. I can control and manage my insurance policies. I can optimize my risk capacity. I can target capital. I can target my capital allocation strategy, or I can stimulate risk capital expansion. I can attract alternative capital into the circuit, so I can write more of this risk. How do we do it? We do it by leveraging our data lake and applying advanced analytics in that data, a combination of Bayesian modeling and machine learning algorithms. And we have three main data sets that feed our data lake. The first, Inside Out, helps us to map out all the assets, industrial assets in an industrial network, all the vulnerabilities, and all the controls in place or the lack of them in these really large industrial systems and networks that are not so easy to map out. Our outside-in data set allows us to identify how the clients can be attacked and how attractive they are to the attackers. And the business intelligence component helps us to understand the maturity levels, the cybersecurity maturity levels of the client. Plus, it gives us some financial information to perform that last translation of the risk into dollars at risk. We use all of that information and follow well-recognized international standards and methodologies, such as FAIR methodology, a taxonomy of the factors that contribute to the risk and how they interact with each other, Mitra attack framework for attack mapping, and SIS controls, NIST, CSF, ISO 27001, etc. All in a fully SOC 2 compliant product. Our D-risk risk assessment engine is SOC 2 compliant at this point, and soon will be ISO 27001 compliant as well. The result of all of that calculation is presenting our customers with the frequency of each potential successful attack and the financial impact of each of them. Impact that we calculate in first and second components. And we do that at the unit risk level and at the portfolio aggregated level. Portfolio is paramount, is absolutely key for the insurance industry. Plus, the system provides also the client, the user, with a list of mitigation recommendations based on financial KPIs. By doing this, DeNexus creates a level playing field for all the different stakeholders, from the operator on the field to the control room, from the operator on the field to the security operations center, and through there to the boardroom, and also to the risk underwriter and the reinsurer sitting at the back end of the risk as well, all with transparent data and transparent models that all the different stakeholders can audit. Parties that now can answer all of those hard questions. Industrials, what is my financial exposure to this risk? And what is the return on the risk reduction investments? What is the risk that I want to transfer? And what is the fair price to transfer that risk? What is the fair premium that I need to pay to transfer that risk? And for the insurance alike, proper risk selection, development of new insurance products that better serve the needs. Once you have visibility of a risk that is dynamic and volatile, you can create new insurance products that track that dynamism, that volatility, and offer better terms and conditions, including fair premiums for that risk transfer, all enabling for the insurers an efficient allocation of capital, matching risk with capital, and increasing the capacity to underwrite risk and go above that 1% loss threshold. And this is how the platform looks like. The risk assessment is presented in the form of financial KPIs and key risk indicators, such as most probable annual loss, expected loss, the value at risk in different percentile or confidence level scenarios, or the tail risk also in the same percentile or confidence level scenarios. And on the right-hand side, we see how the risk evolves over time. Green is risk reduction, red is risk increase. Where did the risk came from? Why did it go up or down? Did it happen because of internal or external factors? And how do I compare with my industry peers? Something that any executive wants to know. This is important, calculating the impact of the mitigations. What should I do to efficiently reduce the risk? This slide shows a real-world case study, same risk, and 4 totally different risk mitigation scenarios. On the top left, we see what should be done in case prioritizing the risk reduction is the goal. Money, budget is not the problem. I want to reduce risk fast. Top right, prioritizing return on the investment, on the dollars invested on reducing that risk. On the bottom left, prioritizing the net present value of the investment. And on the bottom right, prioritizing the payback period of that investment. Again, same risk, 4 totally different risk mitigation strategies. And the platform allows the user or empowers the user to choose or to analyze different scenarios and choose what is the one that better fits the risk management mandate or policies. Now let's spend a couple of minutes talking about the underwriting process of any risk, but cyber risk in particular. A major principle that the insurance industry operates on is risk diversification. The more diversification in an insurer's portfolio, the greater leverage that they can apply on risk capital allocated, thereby maximizing potential profitabilities. Cyber risk is the first opportunity in decades, in several decades, where the insurance industry can develop a brand new product line, the cyber insurance, a product that can contribute to that diversification, and a product that on itself offers a revenue growth opportunity and profits to the insurer's portfolio. The challenge, as we have seen, is the lack of quality, the lack of evidence-based data for underwriting that insurers usually enjoy when they underwrite other more mature, more traditional lines of businesses, which results on that lack of insurance capacity discussed in previous slides. Now let's compare side by side. On the left, we have how they operate, how the insurance industry operates when they write any of the traditional risks that they do. On the right, the actual state of the art when it comes to cyber insurance underwriting. For any class of insurance risk, the underwriting is based on both quantitative and qualitative analysis, quantitative and qualitative models and assumptions. The quantitative process requires numeric data on exposures and loss information to feed models that they have developed over decades to assess risk exposures and to set the pricing, to set the premium for the insurance policy. Thus, how the data conforms to the needs of the insurer's models is absolutely consequential. Apart from the assessment of risk exposures and to set pricing, the data is used for a variety of activities, including the calculation of the required capital allocation against a given exposure, loss reserving provisions for balance sheet purposes, the aggregation of all the risk exposures across the specific product line portfolio, or the aggregation of that exposure across the insurer's overall portfolio of products. It also enables compliance, regulatory compliance and rating agency compliance obligations, which are absolutely key for the health of the insurance business. The lack of that quantitative data and the lack of analytical tools impacts the underwriting capability in a truly negative manner, which is what is happening with cyber insurance these days, and why the market is reacting the way it is to the unfortunate set of events in 2021. Absence of that qualitative data, the cyber insurers have utilized qualitative measures, which are acceptable for the most part to assess the quality level of a client's cyber defense, but they are not helpful for the rest of the business. The consequences of this lack of data or data inadequacy are that insurers cannot supply the capacity that they could because there is no quantification of the underlying exposures, or they don't have the ability to map actual exposures to the limits of the insurance. The pricing, again, is going to the roof. It's been really opaque because it is difficult to perceive, and it is difficult to perceive its true value. Terms and conditions of the policies are really curtailed for what might otherwise be possible. Now, thanks to our risk quantification platform, producing evidence-based quantified data in real and continuous time, the positive impact to the insurers is truly manifold. It enables insurance companies to perform an insightful selection of the risk, to perform a prudent capacity setting, valid capacity allocation, proper loss reserving, judicious accumulation assessment and control, and understand plausible catastrophic scenario and perform analysis on them. All of that to enable regulatory and rating agency compliance, and with continuous updating of the models as new evidence-based information becomes available to the platform. That empowers the insurance industry to underwrite the large cyber risk at scale and to create the capacity that it needs to serve the increasing demand by attracting alternative capital into the circuit. So, what are the key takeaways from the webinar, if I may? We have summarized them in these 6 bullet points. A, the industrial sector of the global economy is truly facing a risk and capital crisis that is consequent upon potential catastrophic cyber risks. This capital crisis could be a risk capital gap of $1 trillion. It's a big number. Cyber risk transfer is still below 1%. That coverage gap is gigantic compared to almost 30% for natural catastrophe risk, a risk that in some fashion is similar to the cyber risk in the sense of low probability, high impact type of event. The insurance industry as a whole does not have the capacity to underwrite the increasing cyber risk for industrial enterprises. Alternative capital is necessary to build that capacity. Proper evidence-based cyber risk quantification is required for truly understanding management, mitigation, and transfer of cyber risk, and to build additional capacity. And this concludes today's webinar. Thank you very much for your attendance. I hope that it was a really good use of your time and that you found it insightful. I'm going to send this back to Thomas. Thomas, I think that you have additional information to share. Thank you very much, everybody. Thank you so much, and goodbye.
No need to follow that with too much information, but I do want to pick up, something that's super impactful for me. Why I joined DeNexus in the first place. What Jose said about $1 trillion plus of cyber risk exposure, that's real, and it's only covered about 1%. He said also you have catastrophic cyber insurance, let's say flooding, natural disaster, things like this. That's around 25% covered. So what we really have is the industrial asset owner and the cybersecurity vendor. The background that I come from, as I mentioned earlier, is overexposed. You're exposed. You're not cyber resilient. You might have cybersecurity tools, but in the event of a catastrophic loss due to a cyber event, you're highly exposed to risk. Meanwhile, the cyber insurers can't service the market. That's obviously represents a huge expansion to their total available market. And as Jose said, a new financial or insurance product that they can offer the market for the first time in a number of decades. So never before in my career have I seen two sides of I guess you could say a problem on both sides of the table, having a common problem and a single solution that's not offered the market yet. So that's what we do at DeNexus. That's why I wanted to point you guys to DeNexus.io. Please go online to check out the use cases that we already have underway with the customers on the industrial asset side, and also check out our solution approaches with de-risk industrial versus de-risk insurance. Similar technology, same modeling process, but addressing the business needs for the asset owner with capital equipment and items and operations at risk, and those insurers that keep them safe from catastrophic loss. So with that, thank you, Jose, for explaining what cyber risk is and what it means for the financial markets.
Thank you, Thomas. I've just seen that probably the presentation didn't flow. If you didn't see the slides, I apologize, and you will receive a copy in your inbox. I'm sure that Thomas will take care of that.
Great. Thank you.
Thank you, everybody.